Hi, everybody. So today what we're gonna do, I'll start the share right now, um, is walk through the financial component of the business plan. So last week we talked about the narrative, and the narrative tells the story of what you're trying to do. And then the financials tell the story of how it's going to financially happen. There's three key documents to your financial workbook. So what we have here and what we're going to share with you is a financial workbook. This happens to be basically like my book bag of workbooks. So you'll see that there is a whole lot of tabs because anytime I'm working with a farm on a business plan, I bring the kitchen sink with us. So if we're working on a family budget or if somebody's deciding that they want to consider what's their farm going to be worth when they go to sell it, like we have all of those extra tabs, but you don't need to worry about those. To start with, when you're starting your business plan, the three key things you want to focus on is your income statement, which is this first tab, and then your cash flow tab, and your balance sheet. And we're going to walk through the three tabs and what they mean and why they're important. So the income statement is your profitability tab. It tells you if the business is a financially sound business. So can you generate enough money from the work that you're doing to cover the cost of doing that work? And what I tie into the income statement, because for me as a business planner, when I'm working with you, I want your numbers to be meaningful to you. And as a business planner, I want it to be helping you make decisions. So I tie in production metrics to your profitability tab because that'll help us analyze, well, if income is going up, did income go up because we raised prices, or did income go up because we actually produced more product off that same 2 acres this year? So what we want to understand is, and especially if you're setting initial assumptions, which when we talked about in the business plan, you tell yourself what you're trying to do and then how you're going to do it. And the how is a bunch of assumptions. And so here, what we might say if you haven't got historical actuals is you might have assumptions on how much product you're going to make off of those 2 acres. And then what we'll do at the end of the year is then you get to go back and you say, okay, my assumption was I was going to generate this many pounds of tomatoes off that 2 acres. Did that happen or not? So it's not essential to have production metrics attached to your income statement, but I put them there for a business planning purpose. So the income statement is your profitability tool. And the big difference between the income statement and the cash flow is that the income statement is going to take into account the cash income and the cash operating expenses. But it's also going to take into account this thing called depreciation, which is technically a non-cash expense. Although in the cash flow, you'll see that really did happen. So what the income statement wants to do is assess if the business is profitable or not. So if you need to go and buy a BCS walk-behind tractor for your 2-acre plot, for example, and say that's going to be a $10,000 investment, in the year in which you actually buy it, that's a $10,000 money out the window. So that's a cash flow thing. We'll talk about that in a minute. But on the income statement, what we want to know is, well, how long is that BCS walk-behind tractor going to be useful to you? Maybe it's got a 10-year lifespan on your farm, the way you take care of it, and you've got a garage to put it in when you're not using it and it's bad weather out. So that means that the asset expense, the depreciation of that item for you, because we're going to do a straight line depreciation, meaning that we want to know what is the actual useful lifespan of that asset to your annual operating expense. So if it's a $10,000 tractor, BCS walk behind, and we think it's got a 10-year lifespan, then it's going to have an annual usage expense to hit your profitability assessment of $1,000 a year. And so at the end of the day, what we're then going to do is we're going to say, what was all the money that was brought in from the business, just the operating income that the business generated, less all of the expenses, both cash and amortized or depreciated expenses, so cash and non-cash, the annual expense associated with your assets to operate the business. Similarly, on the income side, we're going to take into account your non-cash income. And that can be really tough for folks because if it feels like, well, the farm is actually profitable, but you still don't have enough money coming in to pay yourself, that can be a frustrating thing. But what we will find is that oftentimes farms are profitable. They're generating enough income for the cost of production. But sometimes what happens is that income isn't cash income. And also there's a lot of expenses that are not considered expenses, such as debt service, money going out the door, that winds up making you feel like you still have no money at the end of the day. So the non-cash income that might hit your profitability statement would be barter or food that you guys consumed on the farm. And we see that a lot. So how much, if you make cheese, how much cheese were you eating or were you giving away to family and friends that you didn't actually get paid for, but that you made and it cost money to make? And so what we want to do is we want to capture all of that value. The other value that tends to, that we want to capture on the income statement is on the non-cash income side of things, is products that take longer than 1 year to come to market. And so if you look at a grass-based livestock operation, for example, sometimes it can take up to 3 years for animals to get to a mature stage where you're going to process those animals. And so there's 3 years worth of expenses that have been hitting the books, but yet you're not going to see the income, the cash income from those animals until 3 years down the road. It doesn't mean that the farm isn't profitable because it has value in that inventory. If you decided to close up shop, you could go ahead and sell those animals at whatever stage they're at. And so you want to show that inventory and the value of the change in your inventory if you have inventory that tends to fluctuate on your profitability statement. So the profitability statement, your income statement, is a measure of, is the farm generating enough income from the expenses it's taking to operate to cover its operating expenses? And you can have a non-profitable farm that stays in existence because of cash flow, in that it has non-farm sources of capital that keep it afloat. You can have a profitable farm, a farm that technically on paper is actually able to generate sufficient income to cover its expenses, that fails because it either doesn't have the income available to cover expenses when they're due. So you might have value in those cows that are sitting on your property, but if you don't sell them for 3 years and yet you have feed bills accruing and the feed bills decide to come after you, then you might go out of business before you got a chance to sell your animals. So you can have a profitable business that does not survive because of money management, which is your cash flow tool. And you can have a not profitable farm that stays in business because it gets outside sources of capital from its cash flow tool. So the first thing that we want to see for a healthy business is we want to see that A, the business is profitable. Then we want to look at the cash flow and we want to say, okay, what are all the sources of money coming in and going out? Not worry about the straight line depreciation, but in the year in which you went and bought assets, how did you finance them? And can you support debt service if you've got debt service? Can you pay your bills when your bills come due? So the cash flow projection is a money management tool, and you're going to see a lot of the same components. That's why I start with the income statement. So you're going to see the cash inputs from the income statement, and you're going to see the cash expenses from the income statement, but then things get a little different. So in addition to the cash income and cash expenses, so we know what's the net cash that the business is contributing, then we want to say, well, what else happened on your cash flow? Did you sell any assets? Did you buy any capital equipment? And so anything that has a lifespan of bigger than 1 year, we typically put on as a capital expense. And then we try to say, okay, and what's that straight line depreciation? What's its useful lifespan? And we try to divide that expense over its useful lifespan for the income statement. For the cash flow, we want to know, oh, if you spent $250,000 to go buy a 20-acre parcel down the street, you spent the $250,000. That's going to hit the cash flow this year. And then if you got a loan to cover that, then we're going to show, okay, we also got a $225,000 loan from Duane, and we're going to show the loan as having come in as a source of capital. So the farm's operating income didn't have $225,000 sitting there available to buy the land, but we did get some outside sources of capital. Grants would be outside sources of capital. If you had owners operating income, so if we had contributions from other off-farm jobs, that would show up as an outside source of capital. So we have the actual capital expense. So we spent the $250,000 on the loan or on the land. We got the loan coming in for that land. And then we started paying on that loan. And so again, in the income statement, when we're talking about profitability, we're not looking at debt service because not every business needs debt to exist. So we don't consider debt a profitability assessment. We do consider the value of that asset's lifespan, and that goes on the profitability statement. But on the cash flow, we actually have, if we have debt, we want to know, well, what is it costing us to service our debt? And do we have the capacity to cover that? So we're going to put what our debt load is if we've got it. And then again, also if we have off-farm income or if we have family expenses, if we're covering our owner's draw from the farm, or even just showing for yourself, if you're doing a whole picture of where's all my money going, so what's it costing for family living? Did we have to pay any income tax? So if there's an income tax expense or an income tax refund, I don't tend to get into the accounts payable differential. That's primarily like if you had accrued expenses that were on your balance sheet, we'll talk about in a minute, and you started to pay them down, we could show the nitty gritty of, okay, well, we had a $10,000 balance on credit cards, and not only in the debt service did we show what we're typically spending on the credit cards, but that we had this outstanding balance that we started to pay down. So I tend to find that I attribute it up here, but I kept these in just to be official. The key is to say at the end of the day, does the business have the cash available to cover all of the cash activities that are happening in this year? And you want to use it as a planning tool so that you can say, oh, wow, if I don't expect operating income to be able to cover the operating expenses plus some of these capital investments, then I need to start making a plan now for where that money is going to come from. And the other component that you want to think about is, did you have cash on hand at the beginning of the year? That information as well. So the accounts payable differential and the cash on hand are going to come from your balance sheet, where we find out, okay, yeah, well, actually 2021 is going to be a net negative, but I had some money left over because 2020 was a good year. So I started the year with some extra money on hand. I keep that to way down at the bottom because first we want to know, how was the farm able to do on its own each year or whatever time period you're looking at. And then we can look at, well, how did the year prior influence the ability to make this year good, or actually make it worse if last year we were starting from a negative position. So the cash flow is your money management tool. And then we have your balance sheet. The balance sheet is for trend analysis. The balance sheet looks at your nest egg. And so the balance sheet takes the value of all of your assets, the things that you own, and it takes a look at all of the people that you owe money to. And it says, if you translated everything into cash amounts, A, do you have enough cash to pay off the amount of people you owe? And after you paid everybody off, what's left, your nest egg? And is your nest egg growing or kind of staying the same or shrinking? And what we want to see is, we want to see your nest egg growing or at least kind of staying the same. And that's why I say that the balance sheet is really a trend analysis tool, because if we see your nest egg consistently shrinking, then that means something's going awry. We're eating up our equity, and we want to take a look at what's happening. We don't want our nest egg shrinking, because at the end of the day, your nest egg is what you've got to retire on. So you want to make sure that your nest egg is growing. You want to make sure you know what you kind of need to be shooting for to retire and where you're at, and hopefully see your nest egg kind of getting you towards that on an annual basis. Historically, when we had dairy farms that were in trouble, what would happen is they would start off with these awesome large tracts of land. And then in years where milk income wasn't sufficient to cover operating expenses, they might sell off a little chunk here and sell off a little chunk there. And slowly but surely, the farm was using its assets to pay its operating expenses. And eventually the farm was left with not enough asset base to even operate the farm properly. So you don't want to be selling off your assets to cover operating expenses. And if we find that we're in a negative trend, again, that's why your balance sheet is a trend analysis tool, is it can raise red flags, or it can actually just raise green flags saying, hey, yeah, things are good, keep on trucking. With the balance sheet, so a couple interesting, like, when would you see a flag? So for example, you want to be taking your snapshot at the same time each year. It doesn't matter what time of year you take your snapshot. What you want is the consistency of the timing, so that your trend analysis is actually showing a trend. And where this can be important is, if you take a snapshot and you decide to do a snapshot in January and a snapshot in August, and you're a vegetable farm, for example, and you're doing root vegetables, you might not have many root vegetables in stock in August, but you might have pretty much your entire harvest available in January. And so in January, you're going to show a lot of inventory on your balance sheet. And if you tried to compare that to August, and August has no inventory, then your inventory asset value is going to be very low. And if all of a sudden you said, oh, there's something wrong, why is my inventory asset value so low? Well, it's because that's a cyclical variation in your business cycle. And so it wouldn't make sense to compare those two balance sheets. But if you noticed, if you did a 3-year comparison, and every January your inventory of vegetables was going down, that would pose a red flag. You're still harvesting the same 2-acre plot. You should have had the same amount of inventory why is inventory down? Is it that you had some drought? Is it that you had some severe weather? And all of a sudden, if you start seeing that we are consistently no longer able to project the amount of inventory we had from that 2-acre plot, well, all of a sudden you might need to start shaking up your business plan and saying, okay, we've got to address this because there's some changes that have now occurred that are impacting our ability to operate the way we used to be. So that's why it's a trend analysis tool. Ideally, you want to see your nest egg growing. And if you see that there's components that are consistently shrinking, that it can raise flags for you to take a look at. So I think what I'm going to do is pause there to take questions, because that is the overview of the 3 financial statements and why they're important. And then if we want to talk about how to fill them out, or if you have questions about how they fit into your business, I'll get a sense of where we want to go from here. And then if Duane wants to hop in and chat too. So I will go on mute and give the floor to Taylor for a minute.
Hey, sorry, I could only see your face, Rose, and I was like, wait. It looks like new. You have a question. Would you like to ask it?
Yes, hi, good evening, everyone. Um, so Rose, my question is, well, I have a lot of questions, honestly, because I wouldn't even know like exactly where to get started with this, but I am very curious about the nest egg as it deals with retirement. So, can you just explain like what exactly is that and like how do you know, get that started and keep it going? Or is it just like a savings? And how do you know like how much to like how often do you put something in, or like how does that work exactly?
Sure. So in my little toolbox of toolboxes, I actually have an extra tab. This is our retirement planning tab. So the retirement planning tab is all about how to figure out what you need. Um, so one of the things that you're gonna want to know, and this is like going into really deep water on this, but when are you planning to retire? And so what we would want to know is how many years after the farm's operating income do we need to be budgeting for as either income coming in from the farm or income coming in from whatever your current source of income is? How many years do you plan to live post-retirement? Because what we want to do is we want to actually be starting to understand what are the financial needs that we need to be planning for so that we can start to create a sort of savings plan for you. And then we look at, well, what are your sources of income going to be when you retire? So are you going to have Social Security? Do you have a savings account or a retirement plan now from a current employer? Do you expect any inheritance? And so once we understand what those external sources of contributions might be, then we can find out, okay, well, what does the farm need to do? And so once we know what the farm's net income is, okay, so in this particular case, the farm's net income was going to be 15,000. And so it was going to have 15,000 times 25 years, I think. So the farm was going to generate about 375,000 towards whatever your retirement needs would be. And then here is where we started to identify, like, what did you think your expenses were going to be? And then we have this little table that talks about how many years. And the reason I did this here was so that you have your inflation adjustment, because we have to remember that costs keep going up. So if we said it's going to cost us 500 a month right now on food, and we know that we're going to have 25 years and it's not going to start for 20 years, then we would use this to kind of just budget that out. So you can start very simply. The key is to start, thinking about it. So what you want to be doing is thinking about, what is it going to cost me to live down the road? Where is that source of money going to come from? And how long might I think I need to be planning for? And it might be a little bit morbid, but it's better to know now, because now is when you can start to make a difference. And if you can start when you're in your 20s, great, because then by the time you're 40, you don't feel like you're playing catch up. And I do have a lot of folks that I start their business planning in, and they're 40 to 45, and the farm is just barely breaking even, and it's never been able to contribute to their savings, and they haven't had off-farm jobs. And all of a sudden it's like, okay, wow, we're starting from scratch. So if you have a chance to, the sooner you can plan, the better. But don't not start planning, even if you feel like you're a bit behind the curve. Is that helpful?
Yes, it's helpful. Thank you. And just really quick, so the farm profit between now and then, is that figure, is that like specifically from income, or that's like all the profit from the farm?
Yeah, so the only profit that you're going to be able to have available from the farm to go to retirement, and this becomes really important, is if we look at the and it's actually going to be the cash available, but it's going to be the cash available after debt service and after other things that you've done with it. And so you're going to have to be really specific with yourself about, if the farm is able to be profitable and have money left over after its annual operating expenses, then how much of that needs to go to debt service? And is there money available after debt service? And then how much of the money after debt service do you need going towards today's family living? And then how much is left over to potentially go towards your savings or reinvestment in the business? And we used to get on a hamster wheel with farms where the minute they had profit left over, they would just go and invest it in a piece of capital equipment because they didn't want to pay income tax. But the problem is that doesn't help you with your retirement, because you can't retire on a tractor. And so we really started to realize, like, wow, we need to be helping people look at, if they are using their farm as their primary vehicle for what they expect to retire on in the future, we have to A, develop profitable farms, and B, make a plan for ensuring that some of that money is actually being set aside for your retirement.
Thank you.
Joel, I see you have your hand raised. Would you like to ask your question?
Yes, hi everyone. Okay, so I kind of have I think it is a complicated question, so I'm going to try my best to word it in there so that you can understand. So this will be for Rosalie. So I'm going to just talk about myself here in this case. So I'm trying to get the farm off the ground. I'm starting it from scratch, okay? And obviously it's clear that, you know, at the beginning you kind of have to wear all the hats in there, right? Do everything on your own and stuff like that. So here's the scenario that I'm picturing it. Suppose that I am able to secure a loan from the bank. Let's just say to not complicate things, just $100,000. Okay, so I'm able to secure these $100,000. So now, when it comes to starting the business, I know that those $100 are going to go out the window immediately, right? I mean, starting from scratch, you got to buy this, you got to buy that, you got to buy everything. At what point should I say, you know, I got to make sure that the farm starts making money so that I can at least pay my bills, so that I don't find myself in a situation where I have to go get a job so I can pay that loan and pay everything else, which is what happens to most small businesses. I hope you can give some advice on that.
Yep, exactly. So that's why we would want to be planning now. And in your case, what we might do is instead of considering the income statement like a year by year, we might do some scenario planning. And the scenario planning might be based on some different production metrics. Because what you're going to want to know, production or pricing or customers, what you're going to want to know is, okay, what are the fixed costs of operating your farm? And then based on the vision you have for your farm, what are you planning to produce? How much of it could you produce? And then based on how much could you produce and what we know it costs to produce it, then what is your cost per unit break even, just straight up? And in your case, we actually need to consider the fact that we have a loan. So we're going to have to include our debt service as part of our break even analysis. And then we're going to have to be able to say, okay, if I know I need to sell 2,000 tomatoes at $3.50 a tomato in order to cover the annual operating expenses of growing 2,000 tomatoes and paying the debt service on that $100,000 loan, then is there a customer base that A is going to pay $3.50 a tomato and B that's going to buy 2,000 tomatoes from me this year? And you kind of want to be doing that before you start getting a loan and before you start investing in the farm, because what we want you to be able to do is at least know on paper whether you have a plan that's going to work before you go out and implement it, and then find out, like you were mentioning, as so many do, that, oh, wow, actually there is not 2,000 people that want to pay $3.50 a tomato in the neighborhood that I live in. Or people only buy tomatoes once a year, and my tomatoes aren't going to be ripe when people come and buy tomatoes. So you really want to be doing that planning so that you can understand what is your cost of break even and how many units am I going to have for sale? And A, will people pay the break even? And B, ideally, will they pay more than break even so there's something left over for you or for your retirement, like we were just talking about with new. So is that helpful?
Yes, that gives me some idea. But keeping on the same vein of discussion, what if I decide to start a farm where I want to raise cattle? Now, if that's what I do, I'm not going to see any money for the next 3 or 4 years. But how do I pay the bank immediately? You know, I mean, it's kind of a catch 2020 here. So I got to borrow in order to build the farm, but then I had to start paying the bank immediately.
Yeah, that's where that cash flow. So we talked about the income statement and the cash flow. On the income statement, you've got the value of those animals sitting there on the land base, but the problem is you're not selling them yet. So you have no cash income coming in. So you're definitely in that situation going to need to have a cash plan for your startup years in which you have expenses going out the door prior to income coming in. Oftentimes what you would wind up doing is actually getting a loan from a bank that's called a line of credit or an operating loan. And the operating loan is meant to service all of the expenses. In your case, it might actually also kind of be including paying the loan. Because if you can get a loan that's, say you get $100,000 loan, but you only need to service it at $1,000 a month, and your operating expenses are going to be $20,000 a year, then technically you should have enough money from the loan itself to be paying your monthly loan payment until 3 years from now your income starts to come in. And most businesses are going to be running a cash negative until the income comes in at a size that meets the operating expenses. So you're going to have expenses that start before the income comes in. That's kind of why CSAs got started with veggies, was to give farms that operating capital in the spring when they needed all that money to plant stuff before produce was ready by the end of the summer. In your case, you're going to need a 3-year startup plan. So what you might do is you might say, okay, I'm going to have this off-farm job that I'm putting away money to be able to start my farm in 3 years from now. But it's definitely something that you'll want to plan out, especially because you're going to be working with an income source that has a significant lag. It's just like when folks want to start a distillery and they're like, we're going to go grain and then we're going to turn our grain into whiskey, but that whiskey takes 10 years to mature. It's like, oh, okay, well, what are you going to do for those 10 years in between when you still had to pay for all the expenses of growing grain? So yeah, it's a very good question.
Thank you. Thanks, Rose.
There's a question in the chat, but I just want to add on a little bit to what Rose said. Like just mimicking, you're going to have expenses at the beginning, no matter what, that you'll just have some upfront costs for. But like in the livestock world, if you're like, or beginning farming in general, you have those long-term products that are going to take a little bit longer to make any profit off of. And sometimes people will include other products that'll have a more immediate profit that might be some, like, for lack of better words, like lower hanging fruit that you can start off with. So like with beef cattle, like I know some people that start off with broiler chickens to help cover some costs at the beginning, and then once the beef cattle business is a lot larger or sustainable, they're able to get those other like streams of income out of their farm business. It's just all leading into one another. But it's just dependent on like what you feel able to do. There's a question in the chat from Pat. She was asking about getting a copy of this income and expense sheets that you have available. Can I include this in the follow-up email to folks, Rose? Okay. So Pat, I'll be sending this in the follow-up email after this class. Probably will send it tomorrow, and I'll include this Excel sheet in there. Are there any other questions right now that people would like to reach out? We'll be able to ask questions at the end too, but just want to give space for anything right now. That's feeling like some silence. I do have a question, Rose, and then maybe we can move on to get some information and thoughts from Duane as well. I guess too, like in our last class, we talked about the narrative, and I guess we talked about bits and pieces of our financial workbook being present in there. I was wondering if you could emphasize again, like what pieces seem really important to include in the narrative of your business plan that's related to this financial workbook.
Yeah. So the most important thing to write down is your assumptions, because the assumptions will help you and any other reader tell the story as to how you got to these numbers. So if you just say, I'm going to generate 50,000 from my vegetable CSA, well, how did you come up with 50,000? So you might come up with 50,000 by saying, well, I'm going to have a 2-acre plot, and this 2-acre plot is going to be focused on tomatoes, and I'm selling my tomatoes at $3.50 a tomato, and I'm going to grow at that rate, we'd need about 15,000 tomatoes. But there, all of a sudden, that's your assumptions. And if you put that, you can put it alongside here in your spreadsheet, but also if you have that in the written narrative section of the financial assumptions saying, in year one, I'm going to get 50,000 in gross income from the farm by selling 15,000 tomatoes at $3.50 a piece from a 2-acre tomato plot. All of a sudden, now both you and the reader know, and then they can tell you, wow, I don't think that's possible, or you can go and determine that you don't think that's possible, or you can go ahead and implement the plan. But you've created an assumption that you can then go back and measure. And also that helps you then do, for example, the market research of your narrative, which is, are there 15,000 customers who want a $3.50 tomato? And then there's the logistical feasibility of, can I grow and generate 15,000 tomatoes from a 2-acre plot. So they all kind of lead together, which is why it's really fun. They build the story and they help your story actually say, is this story, does it hold together? So the key things that you want to include are, what are your assumptions? And then other bits of information, like if Joel said, oh, I need to get $100,000 loan. Well, we want to put that into the financial narrative saying, yeah, for startup, it's going to cost us this much for a tractor. It's going to cost us this much for this and that. We've approached HVADC for a loan. We're planning to get a $100,000 loan. It's a 5-year term. It's 8% interest. Here's our debt service payment. So again, what you're seeing here in the financial workbook is just that you're going to have a $100,000 loan, and you might put in the side notes that it's a 5-year term at 8% interest, but at least also then in the financial narrative, you're going to have explained that. There's a nice little footnote there. And then the reader and yourself can say, oh yeah, that's how I arrived at thinking that I was going to be able to handle this debt load, was because when I looked at the payment terms based off the amount of money I was going to have available, this made sense. So you really, it's kind of, the numbers are here, and then the financial narrative piece in the business plan itself explains where those numbers came from. And so oftentimes what I'll do is I'll be like writing along in here, and I'll just be writing my assumption, and then I just copy and paste my assumptions from here right into the financial narrative. Because that way it helps you see them in real time with whichever documents you're looking at.
I'm going to give you the floor then, Duane. I feel like this is a really good flow into some of the stuff you do.
Yeah, no, this is perfect. Thank you, Rose, again. Just kind of hitting the point that narratives definitely matter, especially when applying for grants, or in this case, applying for loans for HVADC. I'm just going to go over. I shared this slide last time out, but I'm just going to do a little Spark Notes just for the people that haven't seen it already, just to give you guys a little piece of information about HVADC. Oh, let's not do that. All right. So, all right, we're gonna speed through this because I know some of you have already seen it. Okay. So HVADC stands for Hudson Valley Agribusiness Development Corporation, and we're to cultivate ag enterprise and enhance economic growth, yada, yada, yada. This is our mission statement. Essentially, it's just saying that we're here to help you guys out, whether that's through technical assistance or through some of the loan programming, specifically those equipment loans. We have done some working capital loans if you get grants as well. So I'll talk a little bit more about that soon. You guys are smack dab in the middle. You guys are our target market. Right here, you can see Sullivan County. And if you do end up moving, the counties in red and in yellow are eligible for funding. And as we go, and if you want to inquire about some of our processes, I'd love to have some conversations. More of our focus areas, I would assume that most people, I mean, if you're here, I'd assume that you could at least fulfill one of these criteria. So this is kind of what I wanted to talk about. So HVADC is a CDFI, which is a community development financial institution. So like Rose said, we are a financial body that is focused on helping and taking on more riskier loans. We can operate as a bank. However, our criteria is a little bit lower just because if entities like farms and food businesses did not get this funding, then the whole food system would be in a mess, and we definitely don't want that. So we just got this status last year, so we were doing some of this before, and now we're really going full steam ahead. To talk about our loan fund, we offer low interest loans based off of the prime rate. So whatever the Wall Street Journal sets the prime rate, we're going to be at that. Currently, it's at 8.25, and then we're going to minus 1%. So if you were to take a loan out today, it would be 7.25 or 7.5. I'm not too sure, but something along those lines for the specific purchase of machinery and equipment. So when you are taking out these loans, a few things to make sure of is that you have enough collateral to cover that. So we've had a few people come in and ask if we can do a line of credit and if we can work with them and do multiple disbursements. And unfortunately, since we are a new lender and since they are pretty risky, doing that sort of method doesn't make sense financially. Our board that looks at all of the loan applicants, they're not bankers per se, but they definitely think like them, and they will give you a little bit more leeway than a standard bank. But they still do have some standards that they have to do because, I mean, we're getting this money from the government. You can see here that we're getting it from New York's Job Development Authority and the US EDA, like Economic Development Administration. So we do eventually have to pay this money back to the government. They're giving this money in hopes that we can get a return on it. And then once we get a return, that's called an RLF. So it's a revolving loan fund. So we loan more money out. And then we receive money back with interest, and then we keep doing it. And then hopefully we can give more favorable loans as the program grows. And we will tailor it as best we can. So if you are a startup, which I would assume everyone here is, we are able to offer some interest-only periods so that the monthly payment is a little bit lower. I know in the past we've done 3 months, in the past we've done a year. It kind of fluctuates based off of the needs of the client, so we can have further discussions on that one. But definitely utilizing services like Rose and having your big three financial statements, that's pretty much a given. You're going to need to have those tax returns, year-end financial statements. You're going to have that all straightened out, and so that our board can receive it and then assess it. And having a credited planner or advisor like a Rose Wilson, or there's a few other people in our program as well, but having people look through it and go along with you, and then just kind of fact check it and make sure that you guys are doing and make sure that the numbers are looking okay. Having a person like that would be incredibly beneficial for your application to get some of those working capital or equipment loans. And I will get more into that process a little bit. Some of these forms are just going to ask about the business. This form, the SBA form 413, it doesn't take too long it's just some general standard small business loans. Here you can see the project narrative and some aging accounts if possible. And if you have other loans, definitely include that as well. Yeah, we're going to keep on chugging. So I would definitely say accessing and utilizing Rose's services or some other BTA for those planning and projections. It's definitely a start. You might not be able to apply and get awarded the loan immediately. So taking the necessary steps is, in the short term, it doesn't seem like you're doing a lot, but having a solid foundation to build off of, and the most important thing is maintaining it, because we will need the past 3 years of financial records. So doing it every year and making and holding yourself accountable to having those records up to date is definitely the best possible way to always be ready, just in case you do need an equipment loan. There might be a deal or some sort of sale on a piece of equipment that would really help the business out. So being ready at the drop of a hat would be incredibly beneficial for you. So definitely talk to me about the incubator program, and I would love to I'd love to go over that in more detail, but today we're talking about finances. So this is kind of what the spreadsheet looks like. I talked about this last time, but financing, business plan prep, managing the business, you can see that accounting and record keeping, cash flow management, all that fun stuff. So that all falls under our incubator program, which for the people that didn't hear last week, is going to be a 75% discount on those services to get pretty much all the information you need to apply for a grant or a loan. This is in the system. I'm going to exit out of this. I'm going to go to another, let's see, where was that? Okay. So let's say that you were to apply for a loan and get awarded. Another major thing to always have ready is to have that list of equipment being pledged as collateral. Usually, if you are applying for an equipment loan, we will need a description, model number, and the actual cost. This allows the collateral to be put up against the loan. For our loan program, it's going to be 65%. So the equipment that you're purchasing has to, and the collateral that you're putting up for the loan in case you default, which I hope no one here does, has to be at least 65% worth of it. So if you wanted to apply for a loan and you didn't have enough collateral, we might be able to give you a loan, just not as much as you hope for. So we can be flexible, but there has to be some leeway. Hazard insurance for your business. We just want to make sure that you have enough coverage. So if something happens out of your control and it's negative, you want to make sure you're covered. All of this in yellow as well, the articles of organization, which kind of looks like this. So it's just going to say articles of organization. It'll have a whole bunch of information. I've blocked out some of this because this is from another loan applicant, which we just closed on last week, actually. So this is what we call a closing checklist. You can see up here at the top. So like I said, having that list of equipment being pledged as collateral with that model number and cost is going to go a long way. We cannot close on the loan, and I can't speak for all of the information for other programs like Farm Credit East or like any other entity. But generally, they're going to want to know what you're buying and then have that coincide with how much money they're going to be loaned out. Hazard insurance as well. The articles of organization, which is right here. You get this from the state. It'll tell what kind of entity type, file number, file date, make sure that you're in good standing. A filing receipt, which kind of does the same thing, an operating agreement. These are all things that you can get for your business. Certificate of good standing. We can do that for you as well. The proof of publication is essentially just saying that you are an entity and that you are real. So having a publisher do that can be pretty daunting, or it can take a little bit. So if you have questions after, I can give you some examples in an email or something like that. The EIN number, just every business has it, so it's on your tax return, so it should be pretty simple. More insurance stuff, a questionnaire, environmental questionnaire, just making sure that your property's a-okay and it's not dumping oil or anything like that into the earth or into a reservoir. The final list of owners and the percentage owned. If you guys are a sole proprietor, then you don't have to worry. But if you guys have multiple owners and you guys have multiple entities involved in the loan process, we might have to ask for more information based on those other entities. Lease of the property, and we would have to have that for at least 6 years after closing, and then another detailed worksheet and timeline for the project. So if you're just applying for equipment, it might be pay for equipment or put a deposit down in March, and then we get the equipment in August or July or something like that. So that's kind of goes along with the narrative. So having all of these to help close is, I would say, in the in the few years that we've been a loan fund, gathering this equipment can take time. I would say between getting all this documents and getting to closing, it could take from 2 to 4 weeks. So definitely plan accordingly, and definitely work with your attorney or work with whoever can get you this document so that we can get you that loan disbursement ASAP. I know I was talking pretty fast here, but I want to make sure that everyone has a chance to talk for questions. I'm trying to think of anything else.
I have a quick question, Duane, that feels like relevant. For here, you said that like for the programs with you, they need to have a lease for at least 6 years after
Well, yeah,
closing. Is
this
there like any
Mhm.
leeway or play with that at all?
Yeah, so for this loanee, they are leasing a property, but if you outright own it, it would just be evidence of ownership. So it's if you are lucky enough to own your piece of property, you don't really have to worry about this. It'll be changed up, so it's just evidence of ownership of the property.
But for your loans, like if you are leasing, can you have a less than 6 year lease, or is the minimum that you would need a 6 year lease for like these programs?
Yeah, it's definitely not a minimum, but
Okay.
we would definitely want to make sure that you're there for a couple years. Just it kind of goes along with the stability of the business and making sure you're not moving a whole bunch of other places that wouldn't sit well with the loan committee to know that maybe they're like constantly on the move or something like that. So knowing that you are like in one place and you've got a good foundation and your roots are stuck in, that would be great.
Cool. So like evidence of long-term planning with that property in some capacity.
Yeah, yeah, totally. And that could be for our incubator program when we're talking about either succession or we're talking about the long-term plans that could be set out, and you could say that, hey, we are leasing this property for now, but we're going to be closing on another property in a year or however long from now. So definitely transparency is key. But yeah, totally. This is not the whatchamacallit, this is not the standard, or this isn't a set in stone thing. So I'm gonna stop sharing. Yeah, so I hope that was coherent. I had a long day looking at the sun, so